Is the bull market intact?
Yes.
What is this then? Is this like a pause that refreshes?
Yeah, pause that refreshes. And I think that the next leg of this bull market's going to come from a broadening out beyond just the AI story into three other thematics that are emerging. And those are going to center on AI, deglobalization, longevity, which we could talk a little bit about, and deregulation. And what's unique right now about this setup is all four of those are interacting and communicating and accelerating in the same time zone. So we should see an opportunity for investors that have missed this first kind of leg that's been AI driven come into a market. There's still room to go.
So you don't buy the story that the worst of the tariff impact is yet to come, and it's going to hurt the economy, which is going to hurt your broadening story, isn't it?
Well, you know, the economy is funny because oftentimes the economy and the market, they communicate but in different time zones, right? So the economy is always judged in arrears and markets are forward thinking. And this is why so many skeptics on the AI trade a few years ago, for those of us that have been talking about this for quite some time, we're looking for proof of earnings concept, and we just got that last week. And so that opportunity set for this cost-saving, productivity-enhancing bull market becomes an engine in this 11, train car of the S&P. It'll continue to lead the market, but there'll be more opportunity ahead.
So since AI is a big theme of yours and has been, when you see those CapEx numbers, you don't pause at all and say, look, I want to see some kind of tangible return on those tens of billions of dollars sooner rather than later, because you believe that it's still going to come down the road?
Well, what's unique, it's such a good question. It's where people are getting hung up, and I understand it. But we really are in sort of this candlesticks to light bulbs moment where the ability to scale and implement and download this technology to produce earnings power in so many different proven business models is the key to this. It's very different than like the early days of the internet. Now, am I all in on AI? No. A diversified portfolio is a smart way to play this, and there are a lot of different ways. Again, going back to the deglobalization thematics, is also married to AI, because in deglobalization, the world kind of goes into more conflict, and so defense spending increases. And at the chassis of that is how modern militaries are going to modernize their equipment, and that also speaks to AI, just as one example. And so materials, industrials become a great sector play in addition to tech.
Well, I mean, a lot of those areas, frankly, have already seen tremendous gains.
They have.
And you think
best
that's just getting
performing sectors year to date.
Yeah, industrials are like second best.
Yeah.
And you just think that continues?
Well, I think that there's a quantifiable merit to the story with a capitalist kicker, that if you're an investor, by definition, you should be venturing into territory that you think is opportunistic, not something that's already been completely proved. And I think the story is directionally correct. And I think the same thing about interest rates. I see, now remember, my perspective as a senior portfolio manager, I work with real people. Like my clients, they always want to know, well, what do I do now? That's the number one question that I have to answer, because they're putting their kids through college.
Well, it's the most simple but important question.
The simple, what do I do now? Well, interest rates are going lower. That's all we need to know. So if you're overweight in cash, you're getting a pay cut.
But how are you so sure they're going lower, and in what time frame are they?
Well, the time frame isn't as much as the direction that we know the pay cut's coming. And the market typically sniffs this out 6 to 12 months ahead of time.
How many cuts do you think we get this year? Since we were just on that topic at the start of our program.
Morgan Stanley's interest rate team is like a couple plus 5 more next year. And so much of that is going to be data dependent, because I think what this Fed has shown us since COVID is that they will talk the market before they actually take action. And right now, in the last meeting, the market talk that the Fed gave us was, hey, we're not quite so sure.
Yeah, they were pretty hawkish talk, right?
Yeah. So the market's already starting to react. We've seen rates are going lower right now. That's what we need to know. Now, for investing individual client money, 3 to 5 year in the bond curve, enjoy some dividends that are rising in the staples or the utility sector, where we're getting huge appreciation plus great cash flow, plus the growth story, rather than sitting around in money market that you know is going to get cut.
Well, that's the craziest thing. We were having this conversation at halftime today.
There's a lot of crazy things out there,
utilities and power, whereas you used to buy them for the dividends, I mean, you still do, and defensive nature, they're the new growth stocks.
Yeah, it's so true. Well, even look at what's happening at the distortion of the S&P, where you have companies that are producing handheld devices but also producing movies, and they're sitting in a tech sector. But other consumer discretionary stocks that do the same thing are sitting in consumer discretionary. I mean, there's a distortion happening And it's happening very quickly. And this is why breaking apart the S&P 500 is so crucial, because the corridor of opportunity is narrowing. But for investors, the corridor is still open. And that's really my responsibility for investors, is to lean in and invest in that, which is what we've been doing.
All right, good to get your perspective. It's nice to see you again.